Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope you are able to hear me. Good day, everyone. Let me display the PowerPoint presentation. My trading system. It is the 9th webinar in the series of webinars I have been giving in celebration, the year-long celebration of FX Trade, the 10th anniversary. And today's topic I am going to take up is trade at ease. So I explained what are the constraints one could face if decide to enter into the forex market, trading in forex market. The constraints with regard to the players, the constraints with regard to the platforms, and also in our system, the internet connectivity, etc. Keeping all in mind how one can trade at ease without becoming perturbed or without become emotional. So this I am going to explain with the help of a series of slides. So the topics are given here. This is the 9th webinar, and this particular webinar is exclusively meant for those who want to do the leisurely trade or those who are doing part-time trade, employed elsewhere, and subsequently they want to do little bit of trading when free time is available without much of a stress. Then the next webinar is going to be the professional approach to that of the trading. That will be meant for the traders who make it as a profession or a full-time trader or whole-time trader, and that sort of traders, how exactly they can plan their trading strategy. I'll be explaining in the next webinar. Now I'll be recollecting some of the points what they have been given already in the earlier webinars, and only with regard to what are required for our trading decisions. First of all, you need to choose the timing to trade. If you want to do a leisurely trading, then you have to choose the time so that you are not put under any sort of stress. That is very important. So you should not be sleepy or it will be overworking and this sort of thing, and you can leisurely monitor the live market code page and also your trading platform and try to read the intentions of the players from time to time and accordingly take the positions. And probably you know that this sort of traders, if time permits, they can make a note of the initial highs and the initial lows set for the day during the Japanese session between 2:30 and 3:30 GMT, or note it down from that of the chart and choose any time frame which is suitable for them without undergoing any sort of inconvenience or causing inconvenience to the family members. So market continues to give trading opportunities. So all the 3 sessions of the day you come across the trading opportunities prevail in the market. So it is not that only Japanese session or European session or the US session alone will give trading opportunities. Sometimes you may come across more volatility during that of the Japanese session and European session and less volatility during the US session. It doesn't mean that all US sessions are going to be like that. Similarly, there are other occasions wherein the Japanese sessions might be showing subdued move. Subsequently, European and US sessions might show bigger volatile moves. So it all depends upon the traders committing the positions. And if today's Japanese session is not making big volatile move and you are watching Japanese and the European session, you can wait for tomorrow without even keeping awake for the US sessions. If you are situated in Japan or Australia, then you can watch for the next day Japanese session and the European session. The volatility will be there. Either we can do a buy and sell trade or a sell and buy trade. So we don't miss that opportunities at all. The market gives either way opportunities. That is, we can do a buy and sell trade if you are able to capture the low and try to book profit during the game, or after that they are going to reverse the market the next day making an intentional move, then you can do a sell and buy trade. So on Friday, you know that the market after the non-farm payroll went up and many traders would have felt that we have missed that opportunity. Euro and GBP have gone up, but I was giving that advice that you can do the sell and buy trade very next day. And obviously you come across from yesterday, they started dropping. So what has been added as an attribute to that of the market After the non-farm payroll, it has been totally discounted. What is the big deal in following it? If you objectively analyze it, you'll be able to understand that these are all nothing but the triggers for the market. The players try to trap either way the trade. So in that process, we have to identify the moves and try to trade and earn money successfully and consistently from the other market rather than simply thinking that the attributes are real. Then if you want to do this sort of leisurely trading, you have to understand the monthly market cycle. And the monthly market cycle starts from the start of the month and end by end of the month. And so if you follow the market during the first week and the last week of the month, you'll be able to really understand how exactly the market cycle on a monthly basis bring in the volatility. And you could come across a spread of about 1100 to 1600 pips spread in the market. So when there is a capability in the market of making about 1000 to 1600 pips spread, is it difficult to earn about 30-40 pips or 100 pips in the market? It is not at all. And if you watch it carefully and calmly trade it, you will be able to capture at least 200-300 pips out of that. And there is no necessity that all the 1600 pips we need to grab. And in that process, we become more anxious and we try to lose around that 1000 pips. And that should not be that approach to that market at all. So market always rewards patience. So I used to tell everyone who is contacting me, there is no necessity immediately make a plan if a position is making negative net change and a position is unfavorable. If you wait for 1 or 2 days, and obviously you will come across the positions you will try to do profit to you. And only question of that leisurely traders are in a position to earn money from that other market rather than that of the impulsive traders. And these leisurely traders need to understand that less trading will really give them the reward. So this sort of less trading strategy is very, very important when you focus on the market activity on a monthly basis. So we have to use different trading strategies during different market conditions. During the first week and the last week of the month, we will come across more and more of uncertain volatile moves would happen. That will be due to that of the monthly trend reversal time. So during that extreme move condition, invariably use the hedging to benefit from that of the quick moves from that of the market. Suppose you have got a sell position, use the hedging order, and if the sell position is becoming unfavorable, try to book profit on the buy side of the hedge and try to earn out of that. Afterwards, the market will reverse and you can close the sell position with a minimal loss or with the of a profit also. So that sort of trades, if you try to do it, you will not be perturbed at all. And for that, during the month end and the month beginning, try to use the hedging effectively. And during the second, third week of the month, you can probably use the hedging only to limit the risk and try to read the moves carefully. You will be able to really make money from the other market. It is not at all difficult. So basically, if you understand the market timing, that is, whatever the time you choose with regard to intraday, it's fine. Then you have to identify whether we are trading on the first week of the month or whether we are trading on the first day of the week. These things you have to recognize first. And if it is a month beginning time, then you will come across more and more volatile moves. And those moves could be just opposite of what they intend to do during that particular month. Then similarly, the week beginning, they are expected to make a false move. And you watch that. And yesterday you would have noticed that they have been holding Euro and GBP and making small swings and slide without cutting the high. And that is the week beginning, a false move they have shown. And the true intention today, they displayed it by making further slide. So they have created the bullish field on Friday. And subsequently on Monday, they just retained the bullish field. But they wanted the traders to buy with the bullish field, but they are not giving profit booking opportunities. So when it is so bullish, the traders will be afraid of taking positions. So if you turn bullish or bearish, then obviously you will not be able to handle the positions. Instead, you just understand yesterday they gained that level. Obviously, that could be the possible false move for the week beginning. Then the intentional move, today we are able to see that slide, and then if you are able to take a position on a false move time and try to keep stop at entry and continue to watch, you'll be able to maximize the profit in a very big way. And this is the easiest way of trading. But we try to complicate our system, simply thinking that only if it is complicated, it can work. It is not at all like that. Simple logistics will work very well in the market rather than that of any of a complicated strategy. So always make your strategies very simple and which can be easily deployable in the market without much of a homework or without much of a complicated decision, or we have to discuss with somebody and take a decision. Keep in your mind a clear idea how exactly I have to trade when the market is making a slide. Okay, now Euro and GBP have cut the low and stayed below that low. Okay, and what should I do? If you try to see that, immediately you will be able to get a solution. They stayed below that of the initial low for more than 30 minutes. Obviously, they intend to drop further down. So if you have got already a sell position, you can simply trail down the stop in a profit-making sell position and keep a distance of 30-40 pips and calmly wait. Let it get maximized automatically. So your profit is assured. Then in case if you are not taking any position, you are very uncertain whether the market is bullish or not. So you can do a technical trade that they cut the low and stay below the low for more than 30 minutes. Obviously till end of the session, they intend to drop Euro and GBP. Then you can take a sell position and keep hedging on that above that of the initial low. And probably those who have attended the Asian session webinar today, they would have noticed what are the initial lows, and anybody who is able to monitor, probably I'll just show that particular slide also, Asian session, initial lows and the highs. Okay. In the case of Euro, the initial low was 1.3136, which is intact, but market has come closer to that, and it went up to 3180, 85, and then started making a drop. So we are able to understand at that time Euro was rising, but GBP was not following down. So that was mainly to make an upward stop, and in the case of Euro GBP, subsequently the initial low they have breached it. In the case of GBP, 1.5776 was the initial low, they have breached it and staying here for more than 30 minutes. So obviously 1.5752 has become the low, and you can see that if they are not going above 1.5776, then you can take a sell near that and keep another hedging order above that and try to book about 30-40 pips profit, or keep stop at entry and maximize the profit during the slide. So this is the one need to understand the initial lows and the highs between 2:30 and 3:30 GMT. You can make a note of it from your chart. If you are not able to follow the market using the live market port page during that particular time, then subsequent you can understand how exactly you can make trading decisions. Let me minimize this slide. Come back over. So if you apply that specific rule, what I explained with regard to the type of moves and how exactly they are respecting the levels, the initial lows and the highs, you can easily determine what sort of trade you can do. So still you can use the hedging order to limit the risk, and once the position makes profit, keep stop at entry, then your risk is eliminated. Then subsequently trail the stop and earn quickly the money during that quick moves in the market. So your trading time has to be defined. Okay, so I have about 4 hours of free time in the evening or in the night before going to bed. Let me concentrate on some trades, and I will not skip my meal or a supper and things like that. I will go for the supper and come back and watch, and that sort of attitude should be there, and choose your time without affecting your normal activities. Then watch any 2 sessions convenient to you depending upon your local time frame. So if you are able to watch during the evening time, fine. Otherwise, early in the morning before going to the office, if it is convenient, probably you can just watch it. And that way you try to specify, even a full-time trader can specify the two sessions in which they can focus on. All the three sessions, one will not be in a position to watch it unless otherwise they have a shift system of watching it with their friends. So that is a different story altogether. Then, whatever the time frame you choose as far as your local time is concerned, and try to follow it in GMT equivalent. So always try to track the market using the GMT time frame so that you will be able to easily recognize the sessions, the gap times in between, and also the early session, late sessions. Then you will become habituated to follow the GMT time as far as the market is concerned. You are not going to use it for rest of the time, and you will be only focusing the market using the GMT time. Then it will be easy for you to follow the time and follow the market moves and try to trade effectively. Then another important thing is you have to become very, very casual, and you have to be very, very calm and perceive the market with the right sense. So once you start watching the market, wait forcibly at least for 30 minutes. Suppose you open the market around, open the live market code page or your trading platform around your local time of 7 a.m. Then don't do any sort of trade till 7:30 a.m. You just watch the market for 30 minutes. Then your mind will gradually get habituated to that of the market prevailing condition. Otherwise, you will recollect the yesterday's level, and suddenly you will become surprised and you will go in for a quick trade. And that trade will be an emotional trade. Obviously, it will be a wrong trade. Suppose yesterday you have seen Euro is trading around 1.3230 and immediately you open the platform and see that Euro is trading around 1.3180. You will be tempted to buy because it has dropped, so it will go up. That is what you simply assume it and straight away take the position. But if you watch the market for 30 minutes, you will understand that we are slowly cutting the low. Okay, having waited, you get a better level to enter into the market, and you find that it has come to 31.36. And then subsequently, you find that particular low has not been reached. Then you can take a decision whether to do a buy and sell trade, or after the rise, I'll take sell and buy trade. So this way, you can simply reject a trading idea of a buy and sell trade in case if the market is making a slide. Then wait for a pullback, and obviously the next session, in order to induce the traders to take the long position, they will try to gain the level. And once the traders have taken the long position, they are expected to drop it again. So during such gain, you try to take a sell position, and you will be able to book profit either way. So it is a question of the timing is very important, and you have to necessarily watch for 30 minutes before commencing any trade and get habituated to that of the current levels in the market and current trend in the market rather than relating to that of the previous days or the previous weeks, etc. Because we are going to execute our trade today and not in another 10 days down the line and things like that. The levels may give surprise from time to time. So relate the levels only to that of the high and the low set for that particular day, not with the previous day immediately. And if you are continuously trading as a professional and probably hold a position for a longer time and things like that, then you can relate it to that of the previous day lows and the highs and compare it and understand in which way they wanted to drop or how much they could drop or how much they could rise. Those sort of estimates, you can do it. But as soon as you see that level, if you become surprised, immediately refer to that as a high, low and the net change. Then you will be able to really understand what is really happening in the market rather than going for imagination. Avoid such imaginations. Can euro come to 1.30 or can euro go to 1.35? This sort of imaginations, if you continue to keep it in mind, then you will never be in a position to do a right trade. So always see what is seen in the market and see how exactly you can capture some profit out of the market moves. Try to follow the type of moves they are making, then you will be able to really earn money from the other market by taking a right trading decision of doing a sell and buy trade or a buy and sell trade. By relating to that of the high and the low and the net change for the day, as that I explained with regard to the trading strategy. Then relax the mind and the body and don't sit in a uncomfortable posture or something like that. You relax your body, relax your mind and use some diversions. Do other work in your computer and try to attend to your family work also. You can go out and ease out and come back and things like that. And nothing prevents you. Nothing will happen in 5-10 minutes in the market because the players have to really induce the trade to take positions and subsequently only they can trap. So they take a longer time. 24 hours they are taking it in order to trap the traders. And in that, if you are just going away for 30 minutes or 20 minutes, it's not going to affect your trading at all. You are not going to miss that opportunity. The market will continue to show such levels. And also, you try to see that some coloring plans and things like that are being used, or some of the magazines are used, and so that you can read it casually and just look into that of the quote page itself. Then you will find that no complicated analysis is required if you simply develop the habit of referring to that of the high and the low set for the day from time to time of the prevailing market levels. Then you always try to review the pending positions before taking a new position, and this is very, very important. If your pending position is making loss, and don't try to take in the same direction again and again some more positions. Normally traders try to do that averaging of net that way without understanding that they are averaging it every 30-40 pips, and that is not a good strategy because if they take another 100-200 pips away, then obviously it can attract margin call. So you have to review the pending position. Suppose you have got a buy position in euro at 1.33 and subsequently it has dropped and it is showing loss. You have reviewed the pending position and you like to do in an averaging, then you see whether your equity can permit it. And you have to see whether your equity can permit. And in the event if the market drops another 100-200 pips, whether your equity will be able to hold the such position. And also see whether you will be able to use the hedging in the event of crisis. And this sort of understanding or analysis are very important, pertinent for trading rather than simply analyzing the market, which is of no use unless and otherwise it is being employed in your trading. So I am doing thousands of analysis with regard to CHF and subsequently I don't take any position. Is there any benefit out of that? Not at all. And I do so many type of analysis chart study about 15 minutes, 30 minutes, 4 hours, 1 day, etc. in euro and then become impulsive and try to take a position in GBP. That means I just simply wasted my time in analyzing that particular currency and taken a position in another currency. Instead, you try to look for opportunities in the market. Then if suddenly you come across a drop happening or suddenly a quick move happening, we know very well quick moves are false moves. And you find slow moves. Now what you see in the case of euro and GBP, slowly they are making the slide and they are intentional moves. So differentiate the quick moves from the other slow moves. Understand, okay, what they're trying to do. It is not very difficult at all to understand their moves. And if you make such understanding, then it is easy for you to do a swing trade of 20-30% profit and be happy with that. And another important mistake many of the traders do is, in case in a one trade $1,000 is lost. Suppose you have not used the hedging or you have not used the stop appropriately and simply the market is going against and you suddenly become impulsive. I cannot withstand more than this loss. So cut the position with 1,000 pips loss. Then your mind might say, okay, next trade you should earn the $1,000. It is next to impossible to earn $1,000 in the next trade. Always cool down the mind and say that in 3 to 5 trades I'll earn that money. So if you take a perception of that nature, then you will never go in for a over trading or an impulsive trading. And so always losing money in the market is part of the market game. So if you are lost, then it is unfortunate and doesn't mean that you have to lose similar money of that nature, and also doesn't mean that you can earn in the next trade just by taking that opposite position, the same $1,000. People have got the tendency that is they try to do a buy and sell trade. If the buy is making loss, quickly cut it and take a sell position, trying to see that in the sell position they are able to earn about $1,000 profit, and it may work or may not work, and that will lead to that of the aggressive mind of and the impulsive mind will always try to give the fear, and with the element of fear it is extremely difficult to maximize the profit from that of the market. So if a loss is made, accept the loss. Okay, hereafterwards I will not trade without a stop or a hedging. You take a decision, then subsequently when you take a next trade, you have to implement it. And simply, if you say that no, okay, let it come, then I'll keep a mental stop and see what happens. And subsequently, if you miss that opportunity, that means you are repeating the mistake again and again. Then market continues to give that opportunity because of the volatile nature. So either you will be able to do a buy and sell or a sell and buy trade. So every session is valuable. Every session you will get trading opportunity. You should not think that the great opportunity is lost. So euro has dropped from high to that of the low during the Japanese session. So I missed a great opportunity. I was sleeping because I was in Europe, and subsequently when I get up, I find that euro has already lost the levels. So I lost the great opportunity. You may not think like that. Instead, think that, okay, I'll wait for the next great opportunity in the market, and market is bound to give such opportunities because their players have to earn money from the traders. If all the traders turn short, then they have to pull back, and if all the traders turn long, they have to drop it. This is part of the game. So try to go with it of the players. You will find it very interesting, and any time is tradable. Any time is convenient to trade. Then choose the currency pair which has got the potency to move when you are making an observation. Don't stick on only to that of euro or GBP or anything or a cross. And you can always look into that of the four majors and two commodity pairs and also the cross, and see whichever the pair is being actively handled at that particular moment. And I have mentioned in the blog many times that they are handling euro and GBP now, they are handling yen crosses now, or they are handling the commodity pairs now, or they are handling CHF now by making a contrarian move. So from time to time, they take only two pairs at a time and try to trade. So you identify those two pairs wherein they are very aggressive and try to trade in those currency pairs. You will fine tune your trade and you will be able to easily close the position within about 15 minutes or 30 minutes and attend to other work. Then, during the month beginning and the month end time, you will come across the aggressive moves in the market, namely the trend reversals. So, you have to avoid trading with a herd during that particular time. What happens during such time? There could be a quick rise. There could be a quick rise to trap the short sellers, like what we have seen during the first week. And during that particular time, avoid immediately taking a sell position. Suppose you have got a lower level sell and it has become a month end or a month beginning, and you find that your lower level sell is making loss. You simply hedge and hold it. Let that particular week get over. Then you will find that the players, traders, whoever is taking short, the players will aggressively rise the market and hold it using some data release. And obviously everybody will say that, okay, there is double recession in US, so that is why euro has gone up, so it is not going to come down at all, so it is better to do a short covering. Then after doing short covering, when we see the next week, we will find euro has fallen. So similarly, a downside, the buyers are trapped to liquidate their long positions. That is what you come across now. So avoid taking immediately during the first fall itself a buy position. So you have to understand that the players take some time to induce the short sellers to do the short covering, And if the traders are not doing short covering, they gain the level so that their usable margin will get eroded and automatically they will come for short covering. So you have to wait for that in that particular week. Similarly, on the downside, if they are dropping like USD CAD, you wait for them to finish it and subsequently they are not going below that and the week is getting over, then you take a buy position. You'll be able to quickly book profit rather than, okay, how much downside potency is there? Asking me like that in the blog, you can simply wait till the end of the week. You will be able to find what is the potential. So there is no necessity to ask any people. You can easily visualize it if you follow the timings of the market well. Then wait for the traders, herd of traders to buy around the season high or sell around the season low. And then you find that such people are not making profit. After the lowest level sell, they are not seeing profit, or after taking the highest level buy, they are not seeing profit. No upward stop on the higher side or no downward stop on the lower side. Then try to take a sell near that of the high. You can easily book profit, or a buy near that of the low. Easily you can book profit during the rise. That is how the players do. So trade along with that of the players. That is our strategy. Always keep in mind that some unexpected things can happen in the market. So use hedging or a stop. If the hedging is not available, use stop. So whenever there is a reversal or extended stop or you come across the trend reversal moves during the month beginning and the month beginning, you may take a very wise lowest level buy and a highest level sell. And your position might be making profit. So don't think that I need not keep stop at entry, because the players could make one extended upward stop before dropping or an extended downward stop before the rise. So if you use the hedging, you can avoid such unexpected risk. And many of the traders, they would have positioned themselves very nicely by taking very close to that of the high sell position or very close to that of the low for the season and buy position. But they would have kept the stop at entry and they would have filled the stop at entry and gone up. And afterwards, you may feel that your position is lost and the market is flaring up. There is no need to worry that the players could hit your stop and go away. When the players hit your stop and just watch for about 30 minutes, within 30 minutes the reversal move will be very fast. You can re-enter into the market. Definitely, okay, now the extended downward stop and is over and my position will be happily making profit. In fact, you should be doubly happy because afterwards they are not going to make an extended downward stop. So go with that of the market and understand what type of moves they are making it, and always envisage before the shift in trading zone they will make the extended downward stop or an upward stop and be prepared for it using the hedging. Then sudden breakout news can change the market trend. Suppose something happens or some of the leaders are facing some problem or a government is facing some problem, unexpected things happen. And during such things, and the news before it reaches you, it could reach that of the financial professionals. And so obviously you come across, suddenly a drop might happen in the market and later on you see that, okay, something has happened in that. Because of that, the market has corrected. By the time you realize, your position will be making loss. So you cannot take unlimited loss like that. So always expect the unexpected and use the hedging to limit the risk. And once the position makes profit, keep stop at it. These two are very essential. Then also give equal importance to that of the exit. It is not that entry you are fine-tuned and stop also you are able to keep at entry after removing the hedging. You have learned about the hedging strategy. Still, the exit also is equally important. When the going is good, avoid becoming greedy. So simply taking away the limit or trading without a limit is of no use because the market could quickly jump up and reverse. You would have seen a great profit, but suddenly the market has reversed and it might be showing the position making loss. So obviously you have to keep stop at entry and trailing the stop to get a minimal profit out of the trade, and you can move the limit away from the other market 30 pips, 40 pips, and depending upon the momentum of the market, and see up to what permissible level they can rise the market, and try to keep the limit and exit out of the position, because you will get another trading opportunity to take another position and book profit. Not necessarily in a single trade you have to earn all the money from that. So avoid the greed also when the going is good, and use the trading strategy to maximize the profit of trailing the stop and also moving away the limit from the other market slowly, and see how far you will be able to maximize the profit. When they stop cutting the low or stop cutting the high for more than 30 minutes to 2 hours, understand, okay, they have set the low and the high, then try to book profit near that. And you cannot expect 500 pips profit and during such moves unless and otherwise you do a position trade, understanding the monthly market cycle. Then focus on one trade at a time. After taking the positions, you can watch other currencies and don't be tempted to take another position until such time you book profit in that particular one position. You can wait for about 1 or 2 sessions, or you can wait even for 1 or 2 days. Use the hedging to limit the risk and keep stop at entry. Then try to book profit without any impulse decisions. And then finally, once the position is closed, you can think of another position. So that way, if you focus on your trade effectively, and you can, for the knowledge sake, you can still continue to read the market, but don't be tempted to take more and more position in every currency you come across. And that will lead to over trading also. Then once you are able to automatically do these things without any handicap or without somebody telling you that keep the hedging order or keep stop at entry, you are able to dictate to yourself and take quick decisions, then you can diversify the risk, taking the positions in other currencies as well. So always keep in mind that moves are important than levels. So many of the traders have got the habit of, can euro go to 1.35 or can euro go to 1.28? So always they think about the levels, which gives the mental block. And you have to see what sort of moves they are making. When they are gaining the levels, what is the big deal of asking, can it come down to 1.28? And when they are gaining the levels, immediately if you see that 1.33 is being shown, and don't come into the conclusion that they will straight rise it to 1.35. Why they are showing the levels? In order to create the fear. And when the traders are not more afraid and they are done the short covering, afterwards, once the short covering is over, the traders are not afraid of the level, and probably they may be slightly afraid and not to take a sell position. Then afterwards, what is the big idea of rising it further? So understand the levels are shown by the players only to trigger the emotions of the traders, and they are not at all important, and they can continue to show such levels and they can make swings in the market. So what move they are making in the market, if you try to focus on it, you will be able to predict what is going to be the next move. I explained the various types of moves they are making in the market, and you focus on the two moves. One is the stop and the extended move. Differentiate the stop and from that of the extended move. Okay, they have done the extended move today, then see whether they are following the extended move on the next day. Otherwise, it will be an intentional move just opposite of the extended move. Then you will be able to take a decisive trade from the start of the day. So, if you focus on the levels, then you may not be able to concentrate on the type of moves. So, levels can be perceived from time to time in a different condition. So when euro was trading around 1.42, when it came to 1.35, it was considered as a great buying opportunity. But now you find that okay, when euro goes to 1.35, I'll sell. So obviously our perception changes. So the levels have got no meaning. They continue to change in the market. So identify the moves, then you will be able to find automatically the levels or just a question of showing some rise or the drop or making some big candles to create the fear within the trader. Then extreme levels may test the time. During extreme time, like the month beginning and the month end, you find more of a consolidation of the highest level. And if you have got a lower level sell, you have to patiently wait for the week to get over. Similarly, if you have got a higher level buy, you have to wait for the market to reverse. So these things are during the month beginning and the month end time. So if you are a small trader having a little bit of usable margin and you want to improve on it, then you do not want to risk much, then avoid taking positions during first week and the last week of the month. It's very simple. So you will have a holiday on a monthly basis on the first week and the last week. You don't miss that opportunity at all, because whether you buy euro at 1.32 and book profit at 1.3250, or whether you buy it at 1.3150 and book profit at 1.32, ultimately you are getting 50 pips profit. That matters. What level you buy and what level sell is not a matter much. Always you focus on your profit rather than the levels. The levels keep changing in the market. If you try to go with it of the level, then you will invariably continue to maintain the fear and your decision making can go wrong at any given time. Then the consolidation is a patient testing time. You have to wait for that and use that stop and during such time to take position. Then avoid talking to others with a bullish or a bearish feel. So when you are asking an analyst, looks very bullish, what do you feel about it? Don't do that. Because when you use the word bullish and ask the other person, and if the other person says, no, it doesn't look like, it looks like a correction, then you may feel hurt. You calmly ask, can euro go up or come down? Rather than using the word bullish and bearish alternatively. By doing this sort of word, using the words very frequently, your mind will get confused. Even a 30 pips, 15 pips rise, you will call it as bullish, and about even 100 pips also you will call it as a bullish. Probably differentiate slightly bullish and strongly bullish and slightly bearish, strongly bearish. You may use such words, but invariably when you use it, you will really not in a position to understand the moves happening in the market. And once you fail to follow the moves, you get the mental block. And when the currency is falling, immediately you will imagine that euro looks very bearish and it can go down even another 1,000 pips. Already it would have dropped 1,000. Immediately you will add another 1,000 and say, no, it can go down for the 1,000 pips. Then you don't feel like buying it at all. So what is the use of telling that it can drop another 1,000 pips? Then you should be able to take a sell position at least. And even the sell you are not willing to do, buy you are not willing to do. What is the big idea of talking bullish and bearish? So that gives the mental block for you. And similarly, wherever that levels you calculate, okay, this is the pivot point level, this is the resistance level and the support level, and the market comes closer to that, you don't feel like buying near the support or you don't feel like selling near that of the resistance, because you are not able to identify the moves. And if you identify the moves, then obviously the levels are secondary. And you just tune your mind accordingly. Tune your mind for about 15 days or 1 month, then you will be able to see that how you are able to get rid of your mental block so easily. Then avoid pre-planned ideas while trading. So while coming from the office, reading all the newspapers and things like that, when euro comes to about 1.2 1.28, I'm going to definitely buy. When you come and watch the screen, and it might be trading around 1.29, and you find, okay, it doesn't matter, I'll buy it at 1.29 because the maximum it can fall is only about 1.28. So that level gives you a pre-plan idea, and immediately you say that 100% my equity can withstand, you just take a buy. Because other day also another person has asked, anyhow euro is going to rise, can I take a buy position here? Then after the drop, then I'll come across the comments in the blog again and again, can euro go up, can euro go up, and things. So don't have the preconceived idea before looking at the market. After looking at the market, you develop ideas, because that again gives the mental block, because you find that okay, it can drop only 100 pips. Afterwards, if the market drops another 200 pips, it becomes a surprise for you. So trading is really easy. You can trade at ease, provided you don't have any preconceived idea, and simply come to the market and identify the moves, and okay, this gives a buy and sell trade opportunity for me. Okay, this particular currency is good to trade now. Now, for example, USDN has just made the drop and just made a downward stop and subsequently gained the level. So probably it could give me a trading opportunity, a buy and sell trading opportunity, then I'll take a buy. That is how you have to take a decision. This is only an example. Don't immediately go by that. So this is how you look into that of the currency, which could give an opportunity for you. Okay, already GBP has dropped about 130 pips. So at the maximum, it can drop another 50, 60 pips. If the volume is good, it may show about 250 pips net change, net downward move. So there is not much of a potency in GBP while now. So probably look into that of Australian dollar, it's holding up and it is still holding below that of the initial low. I will take a sell position there. That is how you should be able to identify the currencies and price position. So let me minimize the PowerPoint presentation and take up the questions and focus the camera over that of the live market portfolio so that you will see something on the screen happening. Any questions? Nirasha has got a question. Should we talk one more 1 hour high and low for initial highs and low between 230 and 230? Should we take 1 hour? Yeah. During that particular 1 hour, whatever the high set or whatever the low set in the chart, and there might be a slight variation in the live market quote page. The chart, the highest level, it may not show it exactly, and it may take an averaging in the candle formation. If you take the 5 minutes candle and things like that. So accordingly, you can make a note of it and relate it to that of the live market quote page. If the same high is there, okay. Now, for example, euro is 1.3232. That's the high set for today, and it is intact. So in the chart also you would have come across that and make a note of it. And the low is also intact, 3136, and that was formed during that of the Japanese session, and make a note of it. And whereas in the case of GBP, they formed the low as 1.5776, subsequently breached the low and come down and formed a new low. And every 30 minutes is cutting the low, so there is got further potential to come down. So this is how you try to make an analysis. What time frame we see the high and the low? That's what I explained here. From the start of the Japanese session 0030 till 3:30 GMT, you see what is the highest level in a particular currency, the lowest level in a currency. Normally, the highs and the lows are set before 3:30 GMT, and that is used as a reference level by the other players for their market moves and drop. In Europe, we have 3 start sessions. In the morning, futures open at 7 a.m. Europe market start at 8 a.m. In London start at 9 a.m. In that case, what session would you recommend to watch for 30 minutes? I think you have to go through that of the market timings. I have given it in the first webinar. And as far as Forex market is concerned, 7:30 GMT, the session starts. That is for the players. So it is not the other markets opening 7:30 GMT. 7 to 7:30 they make the false move. 7:30 to 8 they make the quick moves in the market during startup time. That is why I said that don't follow your local time. Try to follow the market in GMT time. And I have given the timings followed by that of the players. If you want, you follow it. Otherwise, you can continue to follow your local time and see the success rate. I am not here to enforce it. Would you elaborate on what you mean by pre-plan? That is, don't, without looking into the market, don't make much of a plan. That is what pre-plan is. That is, when euro comes to 1.28, I'll buy, but when it really comes, you don't buy. That's what. Then boycott. Live market code percentage changes. Is that from Asian open or New York close? The percentage is from that of New York close. But you can look into that of the net. That is the actual difference by tip. So that will be more meaningful for us. So I go to that of the slide again. So I take this opportunity to thank FX Street and the participants who have come here to listen to my webinars and webinar series. I got one more webinar to complete in this particular My Trading System webinar, the professional approach to trading. So you have seen the leisurely approach to trading, the professional approach to trading. I'll be explaining tomorrow between 12:30 and 13:15 GMT, that is 11th August. Till such time, bye. See you again tomorrow, and I'll be presenting Asian session live market analysis tomorrow. Thank you, one and all.